Hey guys, welcome back. It's another weekend update video, and I want to do a couple things in this video because it is the last weekend of the month. So I'm going to show you my monthly gains like I do every video, and to let you know how I did, how much percent and how much actual nominal value is my account up from when I started this series 2 months ago. I also want to talk about the Semiconductor ETF, which I found, and actually somebody commented in my previous video called SMH. And the third thing I want to do is obviously show you some graphs and charts that I found that may predict what's to come with the stock market. So let's get right into it. So one of the prior videos I had mentioned I had discovered a semiconductor ETF that was SOXX. And so that was right here. Oh, that's SOCC, it's SOXX. It's an iShares, so our best friend BlackRock runs this ETF. But you can see if we look at the 5-year graph, it's kind of what we want to see in a stock or in a chart, meaning it's just going straight up and to the right. Obviously, these dips are the flash crash of 2018 and then the current situation right now. But you can see if I go to the 1-year chart, pre-pandemic, it was around 268. We just hit 271. So it hit like all-time highs or is back at all-time highs pre-pandemic, so it's completely recovered. I mean, V-shaped recovery right here. So that's what I like to see, and that tells me, so semiconductors, if you don't know, semiconductors, if you want to look at the heat map again, just refresh the page. This is from last Friday, but the semiconductor segment is these stocks. So AMD, Micron, Qualcomm, Nvidia, Intel, and such, Texas Instruments. So those stocks make up the semiconductor sector. So this ETF tracks that sector. So the one thing I noticed though about this ETF in my last video was, one, it's kind of pricey at $260 a share. So if you wanted to trade cash secured puts or covered calls, you would need at least $26,000 in your portfolio, and then even with that, you'd only be able to trade one contract. And the other kind of thing that I didn't like about this was that if you look at its expirations, they're only a couple months apart. So for example, there's only 5 expirations to choose from right now: July, August, October, and then January of next year. So it's not very common, or doesn't have a lot of expiration dates, which makes it impossible to sell weekly options on like I like to do. So actually, I did a little bit of Googling, and I came across another ETF that's run by another company, and this is called the Van Eck Vectors Semiconductor ETF, and the ticker is SMH. But if we look at the 5-year chart on this one, it's nearly identical to the other ETF, SOXX or SOX. And again, pre-pandemic, if we look at the 1-year graph, it was around 152, and we are back pretty darn close at here's 153. So we hit an all-time high. We're hovering around the high 140s, low 150s again. So again, another V-shaped recovery. And again, going back to the 5-year graph, this graph is doing exactly what you want it to do, where the stock or the ETF is going straight up and to the right over time. So this was also more appealing to me because, one, it's about $100, actually over $100 cheaper than SOX. Actually, if you look at the 5-year graph, you can see it's been up 152.8% over the past 5 years. Over the past year, it's been up 34%. And that's including, obviously that's pre-pandemic and post-pandemic. Or I should say post-pandemic, I should say post-pandemic crash for now, right? But anyway, the other nice thing about this is if you go to the options, you can trade options on this, and it has weekly options. So July 2nd, which was this coming Friday, the next Friday, the next Friday, next Friday, and so on. So this one has much more expiration dates. And the best part also is if you look at some of these premiums, they are rather juicy. I mean, look at this. The at the money, if I want to sell a put to open a position, I could sell an at the money put and get $250. It's not that liquid, however, but the bid-ask spread it's wide, but it's not that wide. But the premiums are very appealing. I mean, if you want to get a 0.4% return on your risk just to minimize any sort of risk, but still collect a decent amount of premium, you could probably get in like super low, like probably 136. Let's just do the math on that real quick. So don't need scientific mode. Let's do the 136 strike. So that would be $34, right? Because $34 for 100 shares divided by 13,600. So that's 0.3, actually just a little under 0.3, it's 0.25. So let's try 137. So $46 divided by 100 $13,700. So that's again it's a little over 0.3. So maybe 130 is the sweet spot. 55 divided by 13,800. Yep, that's just under 0.4%. So 138, 138.5. So looking at where the stock is right now, that's about $9 of buffer between where the share price is and where it's currently trading. And like you can see, I mean, if you wanted to be more risky, and I mean, you could make good premium on this ETF. So I actually added this to my watch list because it looks very appetizing. I mean, maybe not right now because we're in such of a choppy area. We're kind of up and down day by day. But I think if we get back into a bull market where we're trending back up, this is looking really appetizing, because I think personally in the future, companies like Nvidia and Intel and Micron and AMD that are producing all these computer chips and like SSDs and things, you know, the world is becoming more and more tech heavy. So companies are going to need more servers and things like that. Things are going remote now, right? With a lot of like telemedicine and telehealth and like DocuSign, where things are getting signed electronically over the internet. You have things like Zoom and Skype. You know, all this stuff takes semiconductors. So I really think that this sector is really going to boom in the coming future. And as I showed you in the past 5-year graphs, it's already been taking off. So I am really liking this. So this piqued my interest. So then I did a Google search about what other semiconductor ETFs are out there that I may not have heard of. So I came across this Investopedia article. I got semiconductors on my mind. Investopedia article that is talking about the best semiconductor ETFs for Q1 2020. Obviously, this article was published February 2nd, 2020, so it's a little outdated given the current situation. But it gives you kind of some interesting facts about the top 3 semiconductor ETFs. So SMH is the one we just looked at. It has an expense ratio of 0.35%, which is actually one of the lower expense ratios compared to all the other semiconductor ETFs. Actually has a dividend of 1.44%, which is actually on the higher end. So this SMH looks really good to me right now because it has weekly options, it has good premiums, has a good outlook and a good track record, in my opinion, looking at the 5-year chart, has a very low expense ratio, and has high dividends. I mean, this is like the dream ETF in my opinion right now. And it tells you a little bit about the company. So it says it uses the MVIS US listed semiconductor 25 index as a benchmark. And that focuses on many of the largest semiconductor companies based in the US. So 2 things there. It doesn't have any foreign exposure. So if you're not really big on China or some of the emerging markets, you don't have to worry about that with this ETF. And it focuses on the largest companies. So you don't have to worry about, you know, some of the smaller companies maybe going into bankruptcy or not faring so well. So that tells me that it's focusing on the largest or hopefully most stable companies. So again, that's good news for me. Top holdings include TSM, Intel, Nvidia. So, you know, great companies that I like to see. So I'm glad that it heavily focused on that. So here's SOX. This is the one we looked at. So you can see the expense ratio is a little bit higher and the dividend is a little bit lower. So that's, you know, not as good as SMH. And looking at what SOX does, SOX looks at foreign as well as US firms. So this has some foreign exposure. And the top holdings in SOX are Nvidia, Intel, and Texas Instruments. So for example, if you're not very big on TXN, then maybe you want to trade SMH instead of SOX because it looks like that's one of its top 3 holdings. And the third ETF that this article states is XSD, which is the Spider S&P semiconductor ETF. So again, has an identical expense ratio to SMH, has about 1/3 of the dividend, unfortunately, as SMH. And looking at what it holds or what it tracks, it says it's equally weighted of mostly pure play semiconductor stocks. So it doesn't heavily favor one company over other. And right now its top holdings, or I should say it doesn't favor them as much per se as maybe some of the other ETFs. And its top holdings are Synaptics, which I'll admit I've never heard of before, SunPower, which I have heard of, but I heard of them, I'm talking 20 years ago. I'm surprised they're even still in business if this is the same company I'm thinking about, which sells solar panels and related products. So maybe it's not the same company I'm envisioning, but also AMD. So this is probably the least appealing to me right now because one, it has a third of the dividend as SMH, and its top holdings, 2 of the 3 companies I've never really heard of or know much about. So I'm kind of turned off to this one, but everything about SMH looks very appealing. So like I said, I put it on my watch list. I'm definitely going to keep an eye on it. And I think if we do enter kind of more of a bullish trend, I'd like to make a trade on SMH. And it does fit in terms of my portfolio balance. So that's another stock. Let me know if you've ever heard of or if you've ever traded SMH. I know one previous commenter in one of my earlier videos said he or she has traded SMH. So I'd love to know how they fared and how they like it. But everything I've found so far in SMH looks pretty good to me. So one other thing I wanted to talk to you about is because we had a relatively red week and a lot of chop, and I'm assuming, and based on some of the comments in my previous videos, that a lot of people may have gotten assigned on their cash secured puts that they held on. So I just wanted to quickly talk about some of the strategies that you could utilize depending on, if you like the stock or not, and how quickly or not quickly you want to get out of the shares. So if you had watched my previous videos from this week, I was all cash all week long. I didn't open any new positions. So let's just take a look at my my favorite stock here, AMD. And if we just go to options, and let's just say you had a $52 put that you had on AMD that was expiring this past Friday. Well, AMD is at 49.80, or it closed 49.81 on Friday end of day. So that means you would have gotten assigned 100 shares of AMD at a $52 strike price. So what are your options now for this coming week? Well, one of your options is now you can run the wheel, and you can run the wheel 2 ways. So the most obvious way, and probably the most popular way, is to now sell a covered call on AMD at or above your cost basis. So let's say, you're very bullish, or actually you're very bearish, I should say, on the market right now, and you want to offload these shares as quickly as possible. So you have 2 options. Because let's say you just want to be as much cash as you can right now because you think the stock market is going to dip again, or have a prolonged dip like we did a few months ago. So you want to get out of the market as much as you can. And in essence, you want to sell off these 100 shares as quickly as possible. So your 2 options are, don't even run the wheel. If you think that AMD is going to go up on, let's say, Monday or Tuesday or Wednesday, just hold on to the shares. And then once AMD, the stock price, is $52 or above, just flat out sell your 100 shares as if you're just selling stock normally. So that way you're immediately out of the market. You've hopefully at least broke even or made a little bit of profit, and now you're cash. However, that strategy relies on AMD going up by about $2 or so from where it currently is, or going up to your strike price, wherever you got to sign the shares at. The other option would be to sell a covered call expiring for this Friday, July 2nd, and hoping that AMD again goes at least to or above your strike price by end of day Friday. So the downside with that is, let's say you opened up a covered call expiring Friday at the $52 strike price, and let's say Monday AMD rockets up to 54, and then it just bleeds off Tuesday, Wednesday, Thursday, Friday, and actually closes Friday at 51. Well, that means you're still going to get assigned shares. Yes, you collected a little bit of premium along the way. But that means you still hold 100 shares of stock. However, if you'd never opened up that covered call position, when AMD rocketed to $54 on Monday, you could have just sold off those shares. So that's the risk. That's the pro and con of both positions there. And obviously, if you hold the stock, maybe it never goes to $52, and now you've made zero money that week. And at least if you had sold the covered call at 52, you would have made a few bucks in premium. So there's the pros and cons and kind of the gamble you're taking with those 2 strategies. The other way to run the wheel strategy would be to sell a strangle on AMD. That way you can collect a little bit more premium. And the downside with that, though, is a strangle by definition is when you sell a put and sell a call on the same stock. So you would want to sell a covered call on AMD at $52 or above, and then you want to decide where you want to sell your put. So let's just say this is 3 strikes above the money, So let's just say we're going to sell a put 3 strikes below the money. So that would mean you would sell a 52 strike covered call and collect $77 in premium. And then you're also going to sell a 47 strike put for the same expiration date on July 2nd. And then you're going to collect $45 in premium for that. So you would collect in total $77 on the covered call. Whoops. $77 on the covered call plus $45 on the put. So you would collect a total of $122. So almost double as if you only sold the covered call. But now the risk is if AMD drops below your put, you're now going to own 100 more shares of AMD at $47. So now if you were trying to get out of your shares, you now own 100 more shares. So now you own 200 shares of AMD. The one silver lining though is that now your cost basis has gone down. Because if you owned 100 shares at 52 and now you own 100 shares at 47, if we divide those two, your cost basis is now $49.50. So your cost basis on AMD just went down. And then the following week, you could sell a $50 covered call if you wanted to, and then break even or make profit because you reduced your cost basis. So that's the pro and con of selling the strangle as part of the wheel. Now, again, the big risk is you could possibly get assigned 100 shares more of AMD. But the benefit of the strangle is that you're covering both options, meaning if the stock goes up or if the stock goes down. Obviously, the stock can't do both. So you're guaranteed that at least one of your options is going to expire worthless. You could always obviously close out one leg or the other, at any point during the week. If, let's just say, AMD is just rocketing up to $60. Well, you'd probably just want to leave the $47 put on, right? Because there's no chance that that's going to get tested. But if you really wanted to, for whatever reason, you could close out that leg and then just let it ride. Although, that wouldn't be smart, in my opinion, financially, because you're basically just throwing away max profit in a scenario that doesn't seem like it's going to get tested. So those are kind of your options, because I know a lot of people, and not just my viewers, but I'm sure in general, got assigned a lot of shares of stock on Friday, especially in the last 30 minutes, because I don't know what happened, but AMD and the market in general just got crushed. I mean, there's like a big rug pull going on the last 30 minutes of Friday end of day. So let me know if you got assigned shares, what you were assigned at. Let me know what your strategy is. I'm curious to hear what your opinions are and what you think you're going to do this coming trading week. So one of the other things that I said I want to talk to you about was show you some of these graphs I found on Twitter. And if we take a look, here's a graph of the Federal Reserve's balance sheet. And as expected, so from 08 to 09 during the Great Recession, our balance sheet really grew. We've kind of been growing a little bit slowly for the past couple of years, really a lot in like 2013, 2014. It's been pretty stable for the past, from 2015 to let's say 2018. For those 3 years, it's been pretty stable. Actually went down up until like late 2019. And then here's 2020. I mean, we are at we're over 7 million, which if you go back to, about 12 years ago, we were at under 1 million. So the Fed's balance sheet is about 7 times what it was 12 years ago, which is crazy. I mean, I'm not sure how we're ever going to lower that, but we'll have to, increase taxes, or we'll see what the new administration wants to do come, this election time, but in the new Federal Reserve. But we'll have to see, because it's getting out of hand, and as of right now, it doesn't seem like there's any end in sight. Although the one little thing is, if you see, it's kind of actually went down just a little bit. And I think that's because Jerome Powell has actually, quote unquote, turned off the printer earlier in June. I believe June like 8th or so, maybe a little bit later, they started doing less QE, or less quantitative easing. So I'm sure that's why there's a little bit of a downturn in terms of the balance sheet. But here's another graph here. So this one shows consumer activity and where we are from normal. It actually breaks it down by region in the United States, but the black line is the average. You can see we're average down 8% from normal. And this tracks categories like beauty, fitness, events, home improvement, moving or relocation, property inspections, travel, and urban transport. So actually the hardest hit area right now is the dark blue, and that's the Central Plains area. The mountain area, which is green, is the least hit, meaning they've they're closer to being back to normal. Or actually, they are above there because they're positive 4%. So actually more consumer activity than normal, which is interesting. But I wonder if it's because there's not a lot of people in the mountain area, so the numbers are just not as they fluctuate more just because the number of people is less. Here's a graph of the current business conditions compared to 1 year ago. So you can see the last time we were at these levels was like 08, 09, right? And this is where we are now. And the Great Recession happened in 08, 09. So again, not really boding well for the current economy in terms of where we are based on these graphs and statistics. And then lastly, here's a graph of the internet stock PE ratio. So you can see that for the past nearly a decade, we've kind of been between 30 and maybe 80. We're currently at 160. We are basically double our previous high, which was in like 2016 to 2017. So again, are we in another tech bubble? Because if you look at the market, the FANG stocks like Facebook, Amazon, Apple, they're the ones that are kind of carrying the QQQ index and the S&P 500. So if those stocks go or those stocks pop, the market is definitely going to come crashing down. All right, so here's what you guys have all been waiting for. So here is my breakdown of my options trading for this past month of June. I know there's still a couple more days left in June, but the next week, the weekend, would fall in between June and July. So, and like I said, I don't, as of right now, plan on opening any trades Monday, maybe even Tuesday. So I think this is a pretty accurate representation of my trading activity for the month of June. So you can see I played pretty much AMD and Micron only. I did have an IWM position that I opened up, but I had only made roughly 1, 2, 3, 4, 5, 6, 7, 8 trades in general. 2 of these were just stock that I had sold off for profit, and the rest were all cash secured puts that I sold. So these stocks that I sold were because I was assigned the prior week shares of stock because my strikes were tested. So you can see that I had at some point 200 shares of AMD. I also at some point owned 100 shares of Micron. And thankfully I was able to sell all of these positions and all these stock for profit. So you can see that my return on risk for every play that I did, my lowest return on risk was 0.4%. My highest was over 2%. That was early in June, my first play on AMD in the month of June. All these positions are obviously closed. I basically had sold 1 contract each of every position. You can see the premiums that I collected, my strike prices that I sold them at, and here's my total profit loss for each play. So here in the lime green on the right side, I started my portfolio value as of June 1st was $26,825.56. My portfolio value as of June 30th was, we'll do it live here. We're going to do that equals this cell plus this cell. So my portfolio as of June 30th, and I'm going to estimate because we're not at June 30th yet, but was $27,547.56. So I made a total profit this month of $722. So if I take this total profit divided by where I started from June 1st, that's a 2.69% monthly gain this month, which I'm pretty impressed with. I'm not too mad about that. So if I were able to do that consistently, which is not an easy feat whatsoever, but if I can get 2.69, and let's just do a rough estimate, multiply by 12 for a year. I know that's not exactly accurate because it's going to compound month to month, but just to do a quick and dirty estimate, that would correspond to a 32.3% gain in a year, which is very good. I mean, that is multiples better than any savings or checkings account is going to get you. It's multiples better than any real estate investment is going to get you. So this is why I like the power of the stock market, in that I think if you do it correctly, and you can still do it safely, in my opinion, you can make great returns on your money. But I'm curious to see if you guys track your monthly returns. Let me know what they are. More importantly, I don't really care too much about what your total profit is because everybody has different account sizes. Because if I had $1 million account, $722 in a month is not that great. But if you have a smaller account, like if you have a $1,000 account and you made $722 a month, that's amazing, right? So I care more about what your percent gain was, meaning comparing to what you started with, what percent more money did you make this month? So I'm at about 2.7%. Leave a comment below what your gain was. Hopefully it was a gain and hopefully you didn't have a loss. But if you did have a loss, I hope it's very little and you can recoup that loss the next month. But I'm going to wrap this video up. As always, let me know if you have any questions or comments. If you have any suggestions for future videos, let me know. One thing I will say, I originally created this channel as a general finance channel. I didn't mean to be so heavily into the stocks and options trading. So I am going to try and incorporate some more kind of financial videos into the channel. Let me know if you would like to see that. Let me know what you would like to see specifically. I've seen some other financial YouTubers kind of do reaction videos based on other videos that are out there kind of critiquing people's budgets and kind of helping them out. So I'm going to try doing one of those videos in the coming days. Let me know what you think about it. Any feedback is good. I don't care if you're harsh or not. I'm not going to take it personally. I just want to grow this channel and I want to give you guys what you want to see. So let me know. Leave comments below. Remember to like and subscribe. I'm very close to monetizing my channel. At last check, I'm about 730 subscribers and I need at least 1,000 subscribers to be able to monetize. But I also need 4,000 watch hours, and at last check I'm at about 3,000 watch hours. So hopefully at some point I can reach 1,000 subscribers and 4,000 watch hours at the same time so I can monetize my channel. But if you haven't already, please share my channel with your friends. Let my videos play in the background while you sleep or something so I can keep racking up those watch hours, because I really want to get monetized. I don't want to be one of those YouTubers that sells you courses and other nonsense like that, because I think it's all worthless in my opinion. So I do want to get some sort of financial benefit from making these videos. So even if I make $1 a day in ad revenue, and of course that's not going to cost you guys anything, that would really help me out a lot. So as always, thanks for watching and happy trading.